Hello, my name is Steve Bigelow with the Candlestick Forum. I've got a very specific trend analysis tool when using candlestick signals or non-candlestick signals. As we can see, there was candlestick sell signals, a Doji Harami up here in the overbought condition, right at a major moving average, the 200-day moving average, that everybody could see. We had a bearish kicker signal right here at the 50-day moving average, telling us this uptrend was not occurring anymore. We were in a bearish J-hook pattern heading for wave 3. This is a non-signal. It's not a bullish engulfing. It's not a bullish Harami. It's just an up day and a downtrend. Often get asked the question, why isn't this a bullish reversal? It's shown a lot of strength. The answer is the Japanese rice traders have had 400 years to analyze chart movements. And if this was some sort of signal that had relevance, the Japanese rice traders would have given a name and described to us why it was a reversal signal. So here's the implication. If you see a bullish trading day without a signal, even though it's in the oversold area, it probably doesn't have the same strength or I want to say lasting ability as if this had been a reversal signal. So that tells us we want to be a little bit more cautious about rushing in, buying long positions. You might short or cover your short positions, but you may not necessarily want to go long. And that was illustrated again today with the market trading lower. There's not a lot of strength yet. So the positive for an uptrend is you haven't closed below the T line. The negative aspect is you're still in this downtrending channel without a reversal signal. If they open these markets lower, we can kind of assume now we've got wave 1, wave 2, wave 3 of a bearish J-hook pattern, and wave 1, wave 2, if it starts rolling over, wave 3 of a bearish J-hook pattern. Same thing over here in the NASDAQ. The lack of a reversal signal says this might not be a strong uptrend, be a lot more cautious. So what we do to enhance our probabilities that we're in the right sector or right stocks is if we can see a candlestick reversal signal in the oversold condition, that's usually pretty good. But you add the fact that they did it right smack dab off the 200, a moving average that everybody could see, that enhances that probability that you're now in an uptrend. So if you see buying, what can you do to confirm that this is the time to be buying? There's other confirming indicators like seeing what the crude oil chart is telling you. They're starting to buy crude oil at these prices right here at the bottom of this channel. An additional confirmation is you can go to other stocks in that sector. You can see the bullish flutter kicker signal in ExxonMobil. Again, right smack dab off the 200-day moving average, improving the probabilities that this strong buy signal is additionally being confirmed by the fact that everybody decided to start buying right here at the 200-day moving average. So buying bullish or buying candlestick reversal signals doesn't necessarily require just identifying the signal, but what are the other confirming indicators that would enhance the probabilities that you've got a new trend in that stock or sector? So when you add up all these factors, if we know that if you come down through a support level, like the 50-day moving average, and come back up, it's called a blue ice failure. If they fail at that level, notice how they had a sell signal or selling after they opened up positive, and then a gap down yesterday. Today they did a doji. So we know what the ramifications are of a blue ice failure. This is the type of information that we can teach people constantly in our chat rooms of what is the high probability trade setup based upon human nature's forming another signal or pattern. Well, if this is a blue ice failure, there's your expected target, the 200-day moving average. If this is the confirmation and then they did a doji, we know that we would be in a very strong trade to go short if prices opened lower tomorrow, because now we have a doji sandwich set up, implying that this candle right here would be the same as this candle right here, which means more than likely we're heading to this area. This is nothing more than taking advantage of what the Japanese rice traders have illustrated as consistent price moves based upon human nature time after time. We know what a bearish J-hook pattern would do. We know that a bearish best friend, a doji gap down, is a strong sell signal. The fact that they did it right here, failing right at the T-line, indicating we're in another bearish J-hook pattern, that if this opens lower, we can be shorting immediately, with the implication that wave 1 and wave 3 are going to be the same. We're seeing the same scenario here in Carvana. Wave 1, wave 2, bearish J-hook pattern gap down, wave 3. Now look what's happening. Another bearish J-hook pattern setting up. Now we can conclude wave 1, wave 2. Notice how they could never get it to close back up above the T-line. The T-line still acting as resistance. Weaker trading now has a high probability of moving this price into wave 3. So tomorrow, if we see the markets opening lower, we can assume that we're in a downtrend. If it opens positive and trades positive, still not telling us we might, unless there's a huge big day, still telling us we might not be in a uptrend. We're just kind of bouncing in here still. So all this information allows you to much better assess what's going on in a price movement based upon human nature. That'll be it. We'll see you in the chat rooms.